Good evening, students. So today we'll be continuing with uh, the procedural laws that we started yesterday. And as you all know that this is a revisionary class. So our discussion would be on the important concepts, followed by some of the question and answer sessions. So first topic that I would like to take up today is chapter 19, which basically talks about the provisions to counteract unethical tax practices. And the key provisions of this chapter is section 270 capital A, which deals with the penalty for underreporting and misreporting of income. We'll discuss this provision in detail, and then we'll take up some other provisions which are closely connected with this topic, like the immunity from imposition of penalty, power of CIT or principal CIT to waive the penalty, and some of the aspects relating to the prosecution proceedings, and waiver of the penalty that is under section 270 AA. Then we also have a black money law and some other chapters like chapter 16, 17, 18. And we'll be taking up those chapters after this penalty provisions. So let us start our discussion on section 270 capital. So probably because this is a revisionary class, I assume that the students are having a fair deal of understanding about the provisions. So what we'll discuss today is the concept, and we'll try to address the questions that the students might have. You can, as you know, you might have access to the BOS portal, so you can just write your questions on the portal, or those who are joining live, they can raise their hand to be unmuted, and you can immediately put forward your questions. So before we discuss 270 capital A, which deals with penalty for underreporting or misreporting of income, let us also have a brief understanding of a provision that was there in the statute prior to section 270 capital A, and that was in relation to basically concealment or furnishing of inaccurate particulars of income. So we had section 271 1C that was part of the income tax law, probably as long as the age of the act is. The provisions continued up till 2016, and from AYS 1718 onwards, the new provisions, that is penalty for underreporting and misreporting of income, were introduced. So prior to this under concept of concealment or furnishing of inaccurate particulars of income, the provisions was there. There were a lot of judgments around those provisions, and a lot of issues were settled. And so to give an example, if there is any addition by the assessing officer in respect of any issue which is debatable in nature, then the courts have held that penalty cannot be imposed. If the assessee has maintained the transfer pricing documentation, and from his side, the assessee has justified the arm's length nature of transaction, and subsequently, if there is any addition by the transfer pricing officer and assessing officer, then the same will not call for any penalty. That there was a specific explanation to this effect. Likewise, if there is any addition made by the assessing officer, which is purely based on an estimation. For example, if I make an estimation and the assessing officer also makes an estimation, that is purely based on a judgment, and therefore the penalty is not called for, provided assessee has cooperated in the assessment proceedings. So largely, the provisions under section 271C, they were in the statute for a fairly long period of time. There was some some areas which involved a discretionary power. For example, the assessing officer might impose the penalty which is equal to 100% of tax sought to be weighted, or it could go as high as 300%. So there was a discretionary aspect, and a lot of issues were there wherein there were debatable point of view. So largely, in order to bring the objectivity, the government brought in and revamped the whole provision concerning the imposition of penalty. So now the provision which was earlier in statute that was on inaccurate particulars of income or concealment of income, that is no more in the book. What we will be learning is penalty for underreporting of income and misreporting of income. Now, both are part of the same section, section 270 capital A. The first part of the section is about the power granted to the officers concerned to impose the penalty. So who is empowered to impose the penalty? It is the assessing officer, it is the joint commissioner appeal or the commissioner appeal, and the commissioner or principal commissioner. Now, these four categories have been, these four authorities have been specifically empowered to impose the penalty. Now, if you read the provision says that it is a discretionary provision. Therefore, while the section is objective, but still there is a discretion granted to the officer to impose the penalty or not to impose the penalty. So these officers may direct the levy of penalty during the course of proceedings if a person has underreported his income. So what is important to note is underreporting. So if there is no underreporting of income, there is no question of imposition of penalty under this section. Now, such a penalty shall be imposed by an order in writing by such authority, the authority which we discussed. Now, the question comes, what do we mean by the term underreporting? Or is it necessary that, so as I mentioned in the beginning, the section deals with two types of issues. One is underreporting of income, another is misreporting of income. Now, one clarification in the beginning of discussion, the misreporting of income attracts the higher penalty, which is 200% of tax, whereas underreporting of income attracts 50% of tax ought to be weighted. So this is the primary difference, and that is only because of the severity of the offense. If the offense is of a serious nature, if the escapement is of serious nature, then probably it will call for higher penalty, that is for misreporting. But what is common under both these situations is there has to be an underreporting of income. If there is no underreporting of income, you can neither levy 50% wala penalty, nor you can impose the 200% wala penalty. So let's understand, when can it be said that assessee has underreported his income? So there are certain cases or situations that they have given. The first one is return of income has been filed. So if the assessee has filed the return of income, you have to see what is the income assessed by the officer and what was the income which was determined under 143(1)(a). So 143(1)(a), as we discussed yesterday, it deals with summary assessment, which is processing of income tax return by the CPC. So if your income assessed is more than the income determined under 143(1)(a), in that case, it will be treated as a case of a underreporting of income. So likewise, for different situations, they have given different criteria. For example, take a case of an assessee who has not filed the return of income, or the assessee who has not filed the return of income, or where the return is furnished for the first time when the officer has issued the notice under 148. Now 148 deals with the reassessment situation. So if I have not filed the return of income, then I'm covered here. Or if I'm called upon to file the return of income under section 148, in that case also I'm covered here. But in that case, what would be the how do I determine if I have underreported the income? In that case, I have to see what is the income assessed under the reassessment provisions, section 148, or if it's a case of a regular assessment, then under 143(2) or whatever be it may, what is the income assessed, and what was the basic exemption limit applicable for that year to that class of assessee. So if the income assessed is higher than the basic exemption limit, it would be presumed that I have underreported my income, and this will call for the evaluation of other provisions to see whether I am subject to the penalty proceeding or not. If it is a case of a reassessment, in that case, I have to compare my income as reassessed by the AO. That means during the course of reassessment, if the officer is making any addition, that will be treated as income reassessed, as a vis-a-vis what is my income that was assessed previously during the course of regular scrutiny assessment immediately before such reassessment. Now we all know that reassessment might happen multiple number of times. So if the reassessment is happening, let's say second time, then I also have to see what was the income reassessed previously as compared to what is the income reassessed now. And if the income which is reassessed now is higher than the previously reassessed income, then that will be treated as an under-reporting of income. So likewise, there are MAT and alternate minimum tax situation where if the return is filed by opting the MAT provision, then the total amount of deemed income or reassessed income as per the provisions of 115 JB or JC vis-a-vis the deemed total income determined under 143 1A. Likewise, there are situations for where there is no return filed, where there is a reassessment, or where there is a 148 notice issued. A person would be considered to have underreported his income if the income assessed has the effect of reducing the loss or converting such loss into income. Now, this takes care of a situation where the income, as per the return of income, if it is converted into higher income, then we will deal with the previous, the erstwhile provisions that we discussed. However, if it is a case of a loss situation, and if the loss is reduced by the assessing officer, then that will also be treated as an underreporting of income. Or if the loss is converted into an income, that will also be treated as a situation of an underreporting of income. Now, this is a gateway provision. That is, if that is happening, it would be presumed that Section 270 capital A prima facie is applicable. And then, of course, subject to other provisions, we will see whether penalty is to be imposed or not. Now, let's assume that the provision is applicable. Then the question comes, how do I calculate the underreporting of income based on different situation? Now, it is quite easy to understand. Where the return is furnished, so as we discussed, assessed income minus income determined under 143 1A, whatever the resultant figure comes, that would be treated as the underreported income. So this is a computational aspect. Largely, it is similar, but then as you see, there would be practical nuances involved. One would ask that if I file an income tax return declaring income of 5 lakh, in the intimation, if my income is assessed under a summary assessment by CPC, let's say 10 lakh rupees, there's a 5 lakh adjustment. Matter is picked up for assessment and my addition is made again of 5 lakhs. So assessed income is 15 lakhs. So should it be 10 lakhs that I have to take it as an underreported income, or it should be only 5 lakh rupees? The answer is 5 lakh rupees, because what the law says that you have to take the difference between assessed income and what was an income determined under 143 1A. So any addition which is made pursuant to an intimation or a summary assessment under 143 1A, that does not call for penalty under Section 270. And this is rightly so, because if you see the scope of Section 143 1A, that largely deals with the cases where there is an arithmetical error, there are any claims which are apparently wrong. So all of this is a system-driven process. So therefore, the system, whatever kind of issues that the system will highlight, that doesn't call for any penalty. Where the return has not been filed by the assessee, then you have two categories of assessee. As we saw that you have to take a basic exemption limit. But for a company or a firm, there is no basic exemption limit. It is always 0. So you have whatever the income that is assessed by the officer pursuant to reassessment, that would be deemed to be an underreported income. And in case of other class of assessee like individual, HUF, AOP, BOI, you have to kind of reduce the assessed income by a basic exemption limit, and then the resultant figure would be treated as an underreported income for penalty purpose. So now we'll come up to cases which are not included within the scope of underreported income under Section 270 capital A. Now, whatever exceptions that are provided in Section 270 capital A, clause 6, now these exceptions are on the basis of principles which the courts, basically High Court, and even tribunals and Supreme Court from last 100 years, they have, given variety of judgments and decisions. Now, this is a culmination of those judgments. This is a sum and substance of those judgment, and department has kind of, codified it in the as a part of law itself in order to avoid. And of course, some of those were also there in the erstwhile section 271C. The first one is the amount of income in respect of which assessee offers an explanation. Now, there would be an assessment in an assessee where the officer is making certain additions or adjustment. Now, then the question comes whether it is an underreported income. The answer is yes. Can I compute it? Yes, the answer is yes. Question comes, does it automatically call for imposition of penalty? Then the answer would depend whether this is a case covered by section 270 capital A subsection 6 or not. If it is covered, then there is no question of penalty, even if it is an underreported income. Now, the first one is assessee is offering an explanation, which is a bona fide explanation, and all material facts have been disclosed to substantiate the explanation. So that means this would cover a situation where the issue involved is debatable. I might have one view, an officer might have another view, and therefore, if it results into an addition, that not necessarily calls for any kind of penalty. Why? Because I've already offered my explanation and my explanation is bona fide and facts have been disclosed. If the facts are not disclosed, then probably the officer has a better case. Second exception, the amount of income, underreported income, is determined on the basis of estimate. So if, let's say, you file your return of income declaring a gross profit of, let's say, 10%, an officer doesn't want to accept your GP. He says the industry is earning much higher. You have claimed bogus expenses and all of it. So therefore, he's just saying that in order to align your markup with the estimate, with the industry, I'm making an addition. Or alternatively, if the officer is making any kind of ad hoc adjustment, even in those cases also, the High Courts and Supreme Court, they have repeatedly held that if an addition is merely based on an estimation, this doesn't call for any kind of adjustment. There could be another example in case of construction industry, where the profits are declared on the basis of percentage of completion method. Now, if my project is going on, the engineer is certifying the building is completed up to, let's say, 60%, and the officer has a different interpretation and he's saying that, okay, this certificate is not valid. It was completed 70, 80%, and accordingly he increases your income. Now, in this situation, even if you accept the addition, that does not necessarily call for any kind of penalty because it is purely on the basis of estimation. The amount of underreported income represented by an addition made in conformity with the ALP determined by the transfer pricing, where the assessee has maintained the information as described under 92D, he has declared the transaction and disclosed the facts relating to the transaction, no penalty is called for. So this is talking about the transfer pricing related issues, as we discussed. The amount of undisclosed income on account of a search operation. Now, this is as such is an exclusion from this provision, but that doesn't mean that penalty is not imposable. In search matters, you have a separate section 271 AAB, which takes care of the various situation. So we'll deal with it in that section. So therefore, for those cases, 270 capital A is not applicable. Now, this is about underreporting of income. Now let's see what is the misreporting of income for which a higher penalty is imposed. Misreporting of income, as such, as I said, first, there has to be an underreporting of income. If there is no underreporting of income, you can't say that misreporting of income is applicable. So, underreporting के related जो भी conditions हैं, वो पहले satisfy होनी चाहिए. वो हो रही है, इसके बाद ही आप misreporting में जा सकते हो. So, underreporting कैसे पता चलेगा? जो initially we discussed, कि assessed income is higher than the returned income. That's a classic case of underreporting of income. Now, how the underreporting of income leads to misreporting of income? First one is a misrepresentation or suppression of facts. Now, this is quite a very, very subjective. Largely, it might cover, lot of situations. Misrepresentation is a very generic term. any kind of addition which the assessing officer makes necessarily may result into a misrepresentation, and it can be proved very easily. So quite subjective, but yes. Second is the suppression of facts. Now this is something that where the assessing officer has to come to a logical conclusion that yes, in this case there was a suppression of facts. Adequacy or inadequacy of facts does not mean suppression of facts. Suppression of fact means the absence of facts in plain vanilla language. Failure to record an investment in the books. So if I have made an investment and I failed to record, and the officer subsequently comes to the knowledge of it comes to the knowledge of officer, and it results into an addition for whatever reason, let's say undisclosed investment, then that also attracts the penalty. Expenses which is not substantiated by evidence. Now this is quite generic. I have booked an expense for, let's say, conveyance and petrol. Officer is asking for a receipt or is asking for any invoice, voucher. If I'm not able to prove, then the matter is over. You don't have a evidence which substantiates the expense. So it's a case of a misreporting. False entry in the books of account. Now, if there is a false entry due to a bona fide mistake, then you would be covered under 270A6. It doesn't call for any penalty. But if it's a false entry in the books of account, which is intentionally recorded and officer has proved it, in that case, then the situation will be covered under the misreporting. Failure to record any receipt having a bearing on total income. Now, can anybody suggest what kind of situation it might cover? Failure to record any receipt in the books of account which has got a bearing on the total income. A very classic and easy example, if somebody is dealing with the tax returns or has recently done, the first thing when we prepare the income tax return, what is it that we do? Take a very simple case. Which document do you look at? Or which document do you reconcile your books with? What is it that you check or cross-check when you file your return of income or a tax audit report? Anybody would want to suggest? If I'm filing a return, what is it that I check? So it is the 26AS. If there are transactions reflected in 26AS or my AIS or TIS, and if I have not disclosed those transactions in the income tax return, the officer can clearly, highlight this aspect that I have not recorded a receipt which is reflected in the books of account, which is reflected in 26AS, not offered for tax. So this is a clear-cut case of suppression of fact, or it also may fall into the failure to record any receipt, which has a direct bearing on the total income. So therefore, what could be the argument to escape the misreporting of income? The argument could be if it's an item of reconciliation, or if it came to the knowledge of assessee subsequent to the filing of return of income under a bona fide error, or if it was a voluminous nature of transactions, so we might have missed few transactions, or if the deductor has deducted the TDS after filing the return of income and it is disclosed subsequent. So in all those situations, you can probably escape the penalty, but otherwise, this would definitely attract the penalty under section 270 capital A. Quantum of penalty leviable. Now, let's come to the quantum of penalty. It's quite easy to remember. If it's a case of a normal underreporting, you pay 50% of tax. That means first I have to compute what is the addition. After addition, what is my tax liability? And based on that additional tax liability, I have to divide it by 2 or multiply with 50%. That is the penalty for underreporting. If it is an offense which is covered under the misreporting classification, then the amount of penalty would be double the amount of tax liability. What is the manner of computation of tax payable on underreported income? So I'll just pause here if anybody has any question, or meanwhile, the students can read this provision and try to understand on their own. So then we can go to the next aspect. Section 270 capital A, subsection 11. Now that simply says that there cannot be any double penalty for the same item of addition or same item of disallowance, either in the same year or in under any other year. Why this separate thing required? What does it mean? Consequential amendments in other provisions, which is section 119, 253, 271A. Very simple. So, as I said in the beginning, section 270 capital A was brought into the statute with effect from AY 1780. Prior to it, it was concealment of income or furnishing of inaccurate particulars of income, which is 271(1)(c). Now that section has been omitted from the law. Now that erstwhile section was mentioned at multiple places, one of which is section 119, section 253, 271 capital A, and likewise there were several sections. Now instead of that, the new section 270 capital A has been inserted at different places. Now let's discuss two important aspects: reduction or waiver of penalty. The first one is section 273 capital A. Now this was there even prior to section 270 capital A. The powers have been vested with the commissioner to reduce or waive the penalty imposed, or so there are two things. One is to reduce and second is to waive completely. So both are possible. He can either reduce it or he can completely waive it. Now, what are the conditions to be satisfied in order to, reduce or waive the penalty? One is you have made the full and true disclosure. So if all the facts are properly mentioned in the income tax return, tax audit report, and financial statements, and the same have also been disclosed to the assessing officer during the course of assessment, then the officer concerned means the commissioner, who is usually a person higher in rank. He would either reduce it or he would waive the penalty. If the assessee has cooperated in the inquiry, that means during the course of assessment, assessee has provided the information and provided full cooperation. And last one, payment of tax. So he should have paid the tax or made the arrangement for satisfactory arrangement for the payment of any tax which may become payable in consequence of any order passed. So if the assessment order is passed, you have either made the payment or you have made the satisfactory arrangement. That means you must have provided bank guarantee. So in all those situations, the penalty concerned can be waived or it could be reduced. But having said that, this is a discretionary power. Now, we will also discuss section 270 AA, which is different from section 273 capital A. How? it is different. Section 273 is a discretionary power to the CIT concerned. He can reduce it or he can waive it, or he may say that, okay, I'm not going to give you the benefit. So there is a complete discretion. Whereas Section 270 AA, which is on page number, I think, we'll just, skip it for a while and go to Section 270 AA, and then we will deal with some examples and illustrations. Immunity from imposition of penalty and prosecution as well. Now, what are the conditions? Now, in this case, the assessee concerned who has been subjected to the penalty proceedings. Now, when it comes to immunity, the application for immunity has to be filed by the assessee, and it has to be filed prior to imposition of penalty. Once the penalty is imposed, there is no option available, but the assessee has to file an appeal before the CIT appeal. So what are the conditions? One, the assessee should have paid the tax and interest that was payable pursuant to an order of assessment under 143(3) or 147 within the period specified in the notice of demand. Now, generally, as you all know, notice of demand is issued under section 156, and the period prescribed is 30 days in general. So if once you receive the notice of demand, you pay the demand within 30 days, there's no question of any. Okay, so the first condition is satisfied then. Assessee does not prefer an appeal. So that is quite obvious. Once you pay and admit, then you have to waive your right of filing an appeal. What is the time limit? Time limit is within 1 month from the end of the month in which the order of assessment is received. So for example, if you receive an order of assessment on 12th of November, then by 31st of December, you can file an application under 270 AA before the officer concerned and apply for the immunity from imposition of penalty. The circumstance in which the AO cannot grant the immunity. Now, following are the circumstances. Please note that 273 AA, 273A, which talks about waiver and reduction of penalty, the application has to be filed with an officer senior in rank, which is CIT or principal CIT. Whereas in this case, you can file an application in prescribed form before the AO itself. Now, before granting you the immunity, what AO has to do is he has to satisfy himself with certain situations. One, that immunity will be granted only if the proceedings are not initiated pursuant to any of the following. Now, if you see the situation A to situation F, all of this is nothing but the misreporting of income. So that means immunity will be granted only when the penalty to be imposed is 50% of tax that is in relation to underreporting of income. If your case falls under a misreporting of income, the penalty from or the immunity from the penalty cannot be granted. So no protection. If it is underreporting, you can apply. Officer is bound to give you the waiver subject to satisfaction of other condition. But if it's a misreporting, please note and remember, no application can be entertained under 270 AA. However, section 273 capital A, which we discussed a while ago, that is still available to you, and that option can be explored, but then the officer concerned would be senior, which is CIT. Now, there is a time limit also, time limit within which the immunity application can be accepted. And that is 1 month from the end of the month in which application is received. So if for me, 31st December is the last day to file an application, for the officer, it would be 1 month from the end of the month. That means the January concerned would be the month by which he has to dispose of my application. And if he's going to reject my application for any reason, then rejection has to be in writing. and it has to be after providing the assessee an opportunity of being heard. One interesting aspect they have kept is that once my application for immunity is rejected, in that case, I cannot challenge that order before the CIT appeal. What I can challenge is the penalty order, which is passed under 270 capital A before the CIT appeal consent or joint CIT appeal under 246 or 246 capital A. Whereas if the order which is rejecting my application for immunity, that please note can never be challenged before the first level appeal authority. The other option which is available to the assessee is, as we discussed yesterday, it's a writ petition where you can directly approach the High Court by filing a writ petition, because one of the criteria for filing a writ petition is where there is no alternate remedy available. Now, because there is no alternate remedy available under the law, you are filing a writ petition. It is bound to be accepted by the High Court. So rest is, we have already discussed about the exclusion and all. So you can just have a look and then we move ahead. In this entire penalty and chapter 19, this is the heart of the chapter that we are discussing. Other provisions are, have been quite self-explanatory. Amendments are also there, but due to paucity of time, we will not discuss each and everything. We'll focus on key aspect. And if the students want me to discuss few things, you can definitely let us know. Shall we move? Now, this is about offenses and prosecution under the Income Tax Act. Now, as you see, there are various provisions under the statute that provide for, okay, this is timeline. I think, sorry. Yes, para 19.3. Now, what kind of provisions which deal with prosecution? I mean, which provisions deal with the prosecution proceedings and the nature of default that is mentioned in this table? These days, what we have seen is the tax department often initiates the prosecution for an offense which relates to delayed deposit of TDS. So if there is a willful default and the other conditions relating to the quantum of default are there, then the system itself picks up the case and the prosecution is launched after giving an opportunity of being heard. And that is largely towards the 276 capital C, which is willful attempt to evade tax, penalty, or interest chargeable or imposable under reporting of the income. Or second is about 276 double C, willful failure to furnish in due time a return of income. So please note that generally what we understand is if I fail to file the return of income, I feel that I will attract at max the fees of 1,000 or 5,000 depending on my income. But that's not the only case. Apart from that, one attracts 234A, B, C interest. And in addition to that, one attracts prosecution under section 276 double C. Now that largely depends upon the nature of offense, the amount of tax that is sought to be evaded. Let's say if you are liable to pay a tax of 25 rupees or more, then the prosecution can be for 6 months to 7 years along with the fine. And in normal cases, it could be 3 months to 2 years. So that means even if the tax payable is as low as $1,000, even in that case, you might also be attracting the provision. Of course, there are certain exceptions, but that has been the norm. So these are just, self-explanatory provisions in the absence of, because we have to discuss other few things as well. So I believe that you can easily go through this. And if there is any query, please raise. $276,000 This is an amendment, and the provision is applicable with effect from 1st of September 2024, which deals with failure to furnish the return in due time pursuant to search cases. Now, if there is a search that takes place at the assessee's premise, he is called upon to file the return of income, similar to what we have seen in the reassessment case, where once the officer is assuming a valid jurisdictions under 148 capital A, then he issues a notice under 148 calling upon the assessee to file the return. So if there's a failure to furnish, even the failure to furnish return in due time, that also attracts the prosecution of 3 months to 3 years. Right? So now let us discuss in module 3. I think the case studies, we may take up a few case studies within the penalty chapter first, and then we move to the case studies which are specifically prepared by the BOS team. Yeah. So this is a case of a partnership firm which is subject to tax at 30%. Just read the question and then we can go through the answers together to clarify the concept 100%. Now, in this case, the income as per return of income is 50 lakhs. The return is processed under 143(1), so that there's a 10 lakh rupees adjustment. So that makes it 60 lakh. Then the return is selected for scrutiny. Order is passed under scrutiny, again making an addition of 15 lakhs, so it's 75 lakhs, and reassessed income is 95 lakhs. So can penalty be imposed under 270 capital A? If the answer is in affirmative, compute the penalty. Now, it is quite obvious that yes, at the first level, that is when my income is raised from 50 to 60, there is no penalty under one because of 143(1)(a) adjustment, there is no penalty. But the moment the income is added, I mean, the addition is made under 143(3)(3), so then there is an underreporting of income. The quantum of underreporting is 15 lakhs, and therefore the penalty to be levied would be 50% of tax that is applicable, assuming this is not a case of misreporting. If it is a case of misreporting, then the penalty would be double the amount of tax. And likewise, if there is a reassessment happening under 147, there is an addition of 20 lakhs. So on this 20 lakhs, you have to compute the tax liability, and then depending on the underreporting or misreporting classification, you will have to determine the penalty which is payable. So the answer is there in the module itself. Likewise, you can just go through the second illustration, which basically is slightly different, because in this case, the assessment has been made under section 144, which is basically a best judgment assessment provision, which we discussed yesterday. Easy to understand? Let's take illustration 3 and then we go to directly to the some other interesting questions. So this is a case of a loss situation. Under 139(1), when I file the regular return, the loss is 15 lakhs. Then it got reduced through 3 different types of assessment. So in exam, if the question is asked, you have to give the answer, but then you also have to mention, because if the question does not specifically provide for a situation, whether it's a case of underreporting or a misreporting, then you have to specifically mention that you have computed X amount as a penalty payable. Why? Because you presume it to be a case of an underreporting, but not a misreporting. You can also give an answer of a misreporting, but the presumption has to be there that in the absence of fact, it is assumed that the penalty is for misreporting or it is for underreporting. So you can see the notes just below the table. None of the additions or disallowance made in assessment or reassessment qualifies for 270(6). That means there is no any kind of relief that the assessee can claim. What were the condition? One, the assessee has claimed the deduction. They have disclosed all the facts. It's a bona fide error and not a willful kind of an attempt to evade tax. And second, addition is based on an estimation. Addition is based on a debatable issue and transfer pricing related. So those situations you recollect and you assume that none of it is attracted in this case. And second assumption that underreporting is not on account of misreporting. Right? So let us now go to some interesting case studies. So I will directly go to the case study number. No, I think that is connected. So sorry. Let's first discuss some concepts which are part of chapter 18, and then we come to the case study, because then you will be able to properly appreciate the concept. So this is a chapter, I think we had discussed this quite at length during our first session. So what is the content of this chapter 18? One is the section 269 SSNT, which is mode of taking or accepting loan deposit and mode of repayment of loans and deposit, and what is the quantum of penalty. Second is the section which was specifically introduced, section 269 ST, which tries to cover the transactions other than loans and deposit. And the section relating to granting of facility for accepting payment through prescribed electronic modes, that is section 269 SU. We have the provisions that specifically deals with reporting obligations on the part of taxpayers, which is section 285B, 285BA, 285BB. So all of those sections require the assessee to disclose certain information, file certain reports, which is what your 26AS, AIS, and TIS. Then we have miscellaneous provisions, for example, 281, which declares any transaction or any transfer to be void if the purpose of that transaction was to defraud the revenue. We have section 292BB, which is again very important, which is basically talks about deeming a notice to be valid or a curable defect, in other words, in certain specified scenarios and situations. And then we have some miscellaneous provisions like service of notice, manner of service of notice, whether the notice is deemed to be invalid if the notice is not served in the prescribed manner, and certain other miscellaneous provisions like authentication of notice and all. Let us discuss the key provisions so that we can easily connect with the case studies later. Just read this provision once. And I think this provision, those who have been doing the tax audits, they would be easily be able to recollect that there is a specific section 269 SS and section 269T related reporting that is required to be done in the audit report. So you all are much familiar with this provision, I presume. And this section carries a lot of importance from, the practical perspective as well. So let's have a look at it. What it says: no person shall take or accept any loan, deposit, or specified sum from any other person, except by account pay check or account pay bank draft, or by use of electronic clearing system through a bank account or through such other prescribed electronic modes. So largely it says that you can't accept a loan or a deposit otherwise than through a banking channel. But then what are the thresholds? Then there are three criteria, and the threshold of 20,000 or more is given. The first one is the transaction value, the amount of such loan, deposit, or a specified sum, or the aggregate amount of such loan, deposit, or specified sum. Second, on the date on which you are taking the loan or deposit, any loan accepted earlier by such person from the same depositor is remaining unpaid, whether repayment has fallen due or not, ignore it. That opening balance is there, it has remained unpaid. The amount or aggregate amount remaining unpaid is 20,000 or more. And then if you take an additional amount, that calls for the penalty, and 216 NSS comes into picture. The third one, the amount or aggregate amount referred to in point 1, which is the transaction value, together with the amount or the aggregate amount referred to in subsection 2. So you have to see it cumulatively. If it exceeds 20,000 or more, then that relates to violation of section 269 SS. For certain class of transactions, the limit of 20,000 is increased to INR 2 lakh rupees. What is it? One, if the loan or deposited is accepted by a primary agricultural credit society. Please note that it is not covering cooperative societies in general. What is important is it has to be an agricultural credit society and a primary agricultural credit society. So it's a PACS, Primary Agricultural Cooperative Society. So don't go by the word cooperative society alone, because you will see that there are a lot of housing colonies which are named, or they are kind of registered as a cooperative society. So the exemption of this 2 lakh rupees, up to 2 lakh rupees, is not for them. The higher threshold of 2 lakh is only for those which are agricultural cooperative society or a primary cooperative agricultural and rural development bank. And most important aspect, if it is received from a member. So if I'm a primary agricultural credit society, I'm receiving an amount from a non-member, then I am again hit by this section 20,000. But if it's from member, then limit is 2 lakh. Or second, a loan is taken from a primary agricultural credit society or a primary cooperative agricultural and rural development bank by its members. So vice versa, both ways. So first we saw 20,000, then we saw an exception where this limit of 20 is increased to 2 lakh. And now third, we'll see when the provision is not applicable at all. When, now quite obvious, if the loan is accepted by government, by a banking company, by a post office savings bank, any cooperative bank, any corporation established by the central, state or provincial act or any government company as defined in 245 of the Companies Act, any institution, AOP or class of institutions which the central government will notify in the official gazette. This is an exemption available to them. Second category, now that is also very important and quite logical. The situation where the persons involved in the transaction, they derive their income only from agriculture or where neither of them has any income chargeable to tax under the Act. So two situations. One, where the person involved in the transaction derive income only from agriculture. Now, this is basically to cover the cases of farmers, those who are solely reliant on farming. They are living in rural areas where the banking facilities may not be there. Farmers may not be literate enough to, avail the banking facilities. So for them, there's a carve-out. And second, where neither of them has any income chargeable to tax under the Act. That means they are earning either an exempt income or they have got no income at all, which is chargeable to tax. So for them, there is an exemption. So then, if you violate the provision, what is the penalty? The penalty is the amount of loan. Simple, no calculation, very easy. 1 lakh का लिया cash consideration और 1 lakh का लिया cross check or bearer check का consideration. Equal amount of penalty will be imposed. No discussion at all. Mode of undertaking transactions. Section 269 ST. 269 SS का एक second version है 269T, opposite version which deals with repayment of loan, largely worded in the similar fashion and penalty also same. Now we'll discuss 269 ST, which is mode of undertaking the transaction. Now, this doesn't deal with acceptance of loan or repayment of loan. It simply deals with any other transaction in general. What it says, let's read out. So you have to see three things. One, the amount is 2 lakh or more, otherwise then by through a banking channel, in aggregate from a person in a day. So एक दिन में एक व्यक्ति से in aggregate देखना है. So not transaction. If Mr. X is receiving consideration from Mr. Y in a single day, multiple times, all of this is to be clubbed to check the applicability. Second, in respect of a single transaction, that means there is a single transaction of amount exceeding 2 lakh is happening. Third, in respect of transaction relating to one event or occasion from a person. So if there are multiple transactions all linked to a single event or a single occasion from a single person, that will also tend to amount to violation of section 269 ST. When the section is not applicable, again, receipt by government, post office, transaction which are falling under the earlier section 269 SS, they are out of the ambit of this section. Now, there have been circulars and notifications, the notifications actually by the Government of India in the year 2017, where they have specified that ST shall not apply to following additional categories. One, receipt by any person from a bank, which is your cash withdrawal. Second, receipt by so cash withdrawal is actually as such, if I'm withdrawing the cash, I'm not receiving as such money from another person for a transaction. It is my money which is lying in a bank account and I'm withdrawing. So as such, there is, of course, bank is a separate entity, but then logically it has been carved out. Second, and even in, I think in the absence of the notification also, one can easily contend that it's my money which I'm withdrawing from my bank account. It's certainly not something which is in relation to any transaction as such. Receipt by a business correspondent on behalf of a banking company in accordance with the RBI guidelines. So if the bank is receiving the money, that's also out of the ambit. So then likewise, there are certain other exceptions that you can easily kind of read and relate with. And those have been out of the purview of 269 ST. What if I violate? Again, no complexity, no complex calculation. Whatever is the amount of receipt which is in violation of 269 ST, हम मान लेंगे कि वही amount आपका penalty. So no subjectivity, no discretionary power, 50%, 200%, कम ज्यादा waiver कुछ नहीं, flat amount. So this is a circular. You can, kind of quite easy. You can read it and quite logical also. Applicability of income tax provisions under 48(3), 269 ST and 114B to cash sale of agricultural produce by cultivators or agriculturists. Now, if you recollect, in certain cases, there has been exception carved out for those transactions. For example, under 48(3), there's a disallowance of expenditure if you make a payment in cash, otherwise than by an account paid check and all of it. Likewise, in Rule 6DD, there is a carve out. And why this carve out and to whom is this exception is applicable? This is applicable mainly to those who purchase the agricultural produce from the cultivators. And this is quite logic, as I said. If you are dealing with the farmers or agricultural sectors, you have to have certain exceptions. So this is aligning with that exception only. So what is the clarification given by CBDT in nutshell? The CBDT clarified that cash sale of produce by its cultivators to the trader for an amount less than 2 lakh will not result in any disallowance. It is not going to attract 269 ST in case of only cultivator, please note, not for other categories. And it will not require the cultivator to quote his PAN or furnish form number 60 to this for this transaction. Then comes one of the wonderful revolutions that we have seen, Paytm, PhonePe, all those, payment gateways. What the government has done, let's see, so far as these payment gateways are concerned. Section 269 SU has been specifically introduced with effect from 1st November 2019. What it says? The section requires that every person who is carrying on business shall provide the facility for accepting payment through the prescribed electronic modes. While you have the banking options, all of it is there. Everybody has a bank account. But what they say is, in order to, in addition to that, you have to provide some additional facility. यानी कि आपको अपनी दुकान के बाहर, अगर आप ये condition satisfy कर रहे हो, या अपनी ऑफिस के बाहर, you have to have a facility established or put in place for your customers or payment providers where they can make the payment through these prescribed modes. Basically, they are talking about this Beam UPI, debit card powered by RuPay, and unified interface, unified payment interface, UPI payment basically. So you need to have a scanner outside of your office to receive the payment. Now, what are the conditions? For applicability or for to whom is it mandatory? The section requires every person who is carrying on business. So number one is you need to have a business. Now, this also includes professionals, not necessarily sellers. Facility of accepting payment through the prescribed electronic mode, in addition to the facility for the other electronic modes of payment, if any, being provided. If, now to whom is it applicable? Your sales should exceed 50 crore during the preceding financial year. So मेरा अगर पुराने साल का टर्नओवर 50 करोड़ है, उससे ज्यादा है, तो सब्सिक्वेंट ईयर में ये सेक्शन मेरे लिए लागू हो जाता है, मेरे को ये फैसिलिटी देना कंपलसरी. There is an exception that 269 SU shall not apply to a specified person having only B2B transaction. Now, this is quite logical. For a B2B transaction, generally, the mode of operation of business is totally different. And for a wholesale business or a business-to-business dealings, largely it is run through the online banking channels. One is not supposed to have an immediate, kind of a scanner through payment. But yes, in any case, this is a logical exceptions that they have carved out. If at least 95% of aggregate of all amount received during the year, including amount received for sales, are by any mode other than cash. These are the payment. Penalty for non-compliance, 5,000 per day. Simple to remember. Penalty for 269 SS violation, equal amount of transaction. For 269 T, again equal. For 269 ST, which is relating to specified transaction, again it is equal to transaction value. But in respect of 269 SU, it is 5,000 per day if you do not provide the facility. $269T, I won't discuss in detail. Just giving a minute's time, you can go through it. So as you see, the penalty is amount repaid in contravention of 269T. Transfers to defraud the revenue will be treated as void. As a safeguard against non-realization of revenue due to fraudulent transfer of assets by a defaulting asset. So let's say I undertake certain transaction, officer is making certain adjustments, proceedings are going on. If I have if I'm trying to escape the tax payment of tax demand, and department has kind of have all the machinery to recover the demand from me, either by disposal of my assets or by withdrawing the funds from my bank account, forcing the bank, issuing the notice to bank to recover the tax demand that is due. So if I want to escape, what I'll do is I will simply do the transfer. For example, if I'm an owner of an immovable property or a movable property, I will undertake a transfer of that asset. So in this way, I can easily kind of escape from payment of tax. So if there is any such transfer which is happening in order to defraud the revenue, that transfer or that transaction would be deemed to be invalid and it would be treated as void, because it would be established by the officer that it was solely for the purpose of defrauding the revenue. So this is what the provision is talking about. But yes, there are certain exceptions to this rule. Let's read it. What it says. In case where during the pendency of proceedings or even after completion of proceeding, but before the service of notice by the tax recovery officer. So number one, the proceedings should be pending or they should be ongoing, or if it is completed, then before service of notice by the TRO, tax recovery officer, which is different from the assessing officer. Assessee is creating a charge or he parts with or sells, mortgages, gift, exchange, or through any other mode, he transfers his assets or his property in favor of any other person. Then the department will presume that such a charge is non-existent, it is void. The sole purpose is to defraud the revenue, and this is a presumption created under section 281. But then this is subject to certain conditions. The charge or transfer made by the assessee, it will not be void where it is for adequate consideration and without any notice of pendency of such a proceeding. So cumulative condition. One, it's an arm's length consideration involved. And second, it is without any notice of pendency of the proceedings. If that is the case, then the transaction would be deemed to be a genuine one. And second, it is done with the prior permission of the assessing officer. So you are aware of your matter. So you just reach out to AO and ask, okay, I'm doing this transaction. Are you comfortable? Or do you have any objection to it? Then that's fine. What do we mean by the term assets? Probably everything: land, building, machinery, plant, share, security, fixed deposit in a bank, all of it, except a stock in trade of a business. Because, of course, if I don't dispose of my stock, then it is going to impact my business operations. And second, if the item is perishable, it will have no value. So all of this is consciously kept out of it. Provisional attachment to protect the interest of revenue. Section 281B. Why this provisional attachment is required? Now, the purpose of provisional attachment is basically that if an assessment is going on and if the assessment is likely to result into a significant tax demand due to prima facie evidence, while the investigation will be carried out over a period of time and the demand will be raised at a particular date in future, let's say after 1 month, 2 months, 6 months, or 1 year, whatever it is, the department feels that it is necessary that we make a provisional attachment at this moment. If we don't do it, the assessee will either dispose it off or the assessee is going to kind of part with the assets. So if that is the case, the department can provisionally attach it. What is the validity of provisional attachment? The provisional attachment shall be valid initially for a period of 6 months. However, subject to the approval, the officer concerned can extend it in writing for a further period as the officer thinks fit. However, it's never going to exceed the 2 years or 60 days after the date of assessment, whichever is later. So there's a time limit which is given. Now, many a time what happens that if the department is provisionally attaching any property, this might impact my normal living life, or it might result into reputational damage, and it may also result into kind of discomfort and other challenges in the course of business. So what alternative that was suggested by Justice R.V. Iswar committee, that they mentioned that okay, if the assessee is voluntarily able to provide a bank guarantee of an amount equivalent to the potential demand that might arise, in that case, the department should not proceed with the provisional attachment. So likewise, the section has been amended and this kind of a flexibility has now been inbuilt into the law. So then there are timelines and other aspects. So we are not just discussing in detail because everything is self-explanatory. So maybe post break, what we will do is we'll take up some of the case studies and some other provisions which are part of this. Manishi, shall we take a break? Shall we take a break now for 15 minutes? Okay, okay. Okay, all right. So let us discuss some of the case studies and some question and answer sessions to gain a better clarity. So the first question is, just read it once and then we discuss the answer. Right? Now, one of the key aspect of the question is that the taxpayer is an Indian company which is engaged in retail stores. It has a turnover of 70 crores during the preceding financial year 23-24, 45 crore during the running financial year 24-25. It is accepting the payments through all kinds of options, which is cash, check, credit card, debit card, etc. What other compliance it is supposed to do? Now, there we have section 269 SU, which mandates that company is supposed to provide a facility for accepting payment through the prescribed electronic modes in addition to the facility for other electronic modes. So it is taking the payment through banking channel, but there is complete silence about the debit card payment option through RuPay, UPI, Beam UPI, and other unified payment interface quick response code, UPI QR code. So the company is not following that. It is applicable, and therefore the company will be liable to penalty, which is a sum of 5,000 for every day during which the default continues. Now, if I twist this question a little bit, instead of, let's say, a retail stores, if it happens to be a case of a wholesale or kind of a B2B business model, in that case, yes, the assessee is fully compliant and it is not supposed to comply with this law. Let's look at another question. T Limited, it has filed its return of income for assessment year 23-24 on 25th of October 24. The return is selected for regular assessment under section 143.3, for which notice under section 143.2 is served on the company on 9th July 2025. Now, dates are very important to remember here. The company responded to the notice on 143.2. So that means the company has actually submitted a response to the notice which was issued. Now, the question is whether service of notice is within the time, and if not, whether the assessment order can be challenged by the assessee. So now I want the answers from the participants, from the students, on two aspects. Number one, whether the notice is issued or served within time, and second, whether the assessment order can be challenged by the assessee, assuming it is not. You can write your answers in chat box or on the BOS portal link. Whether the notice which is served under 143.2, is it valid or not? That is the first question. What is the answer? Yes or no? Or you can read the question once again if it is not clear. Okay, so one answer is not valid. Second answer is yes. That means, can I assume yes means yes, it is valid? So we have got three answers. Okay. let's assume it is not valid. Then this leads us to the next question, whether the assessment order is valid or can it be challenged by the assessee. Now, here you can assume that the assessment order which officer has passed, that order is passed within the statutory time limit. So, hope you got the question. The first question we dealt with was whether the notice under 143(2), which basically is a notice which leads to initiation of an scrutiny assessment, full-fledged scrutiny assessment, is that valid or not? Now, let's assume it is not valid. In that case, whether the order which is passed by the officer pursuant to an invalid first notice, is it valid or not? And for an assessment order, आप assume कर लीजिए कि assessment order time पे पास हुआ है, it is within the limitation period, वो time barred नहीं है. Please provide the answers along with the reasoning and also the section. When you will appear in the exam, the yes or no will not be treated as an answer as such. You have to substantiate your answer, write properly with the relevant sections, and wherever required, you also have to quote the judgment to support your answer. So your answer should be elaborate, not just yes, no, or not applicable. Okay, so one answer is yes, the notice is issued within the time limit. Okay, what is the time limit? By which date the notice under 143(2) is to be issued by the tax department? The answer has to come from you only. I'm not going to give the answer to this question. Okay, the first answer is yes, the notice is issued within time limit. Okay. And someone else is saying that 30th June 2025 is the date by which the notice should have been issued. So we have now two answers. One is saying yes, it is within time. Second is saying no, it is not valid because the last date is 30th June 2025. Which one is the correct answer? So those who are saying yes, the notice is issued within time, can you please check what is the time limit for issuance of notice under 143(2) and confirm why it is valid? Let's look at the answer now. The time limit for service of notice. So section uses the word service. It doesn't talk about issue. There's a difference between issue and service. So that is just for academic interest. The time limit for service of notice is 3 months from the end of the financial year in which the return of income was furnished. Now, if you look at the dates, the return was filed on 25th October 2024. The notice can be served under 143(2) only within 3 months from the end of the financial year in which the return was filed. Now, return was filed during the financial year 24-25. The year ends on 31st March 25. 3 months from 31st March 25 means 30th June 2025. So those saying that the notice is not valid are actually right. The notice is invalid. Why? Because it has been issued or it has been served on 9th July. So there's a delay of 9 days and therefore it makes the notice invalid. Now coming to the second question, whether the assessment order can be challenged by the assessee. Now, if you see the answer, now this I think we have not yet discussed in the revision class, but in the earlier class we had discussed section 292BB, which says that if the assessee has participated in any proceedings, so even if there is any defect or even if there are any lapses, but the assessee has participated in the proceeding and cooperated in the proceeding and then assessment order is passed, then even if the notice is invalid for this reason or whatever reason, it will be presumed, it will be deemed that the proceedings are valid and assessment order which is passed is valid. Let us look at section 92BB. Section 292BB. Notice deemed to be valid in certain circumstances. Now, let us understand this concept. The section provides that assessee shall be precluded from raising any objection in any proceeding or inquiry that the notice was not served upon him, or it was not served in time, or it was served in an improper manner. So, three things. It was not served in time, or was served in an improper manner if he had appeared in any proceeding or cooperated in any inquiry relating to the assessment or reassessment. So in short, if the assessee had appeared in any proceeding, he has cooperated in any proceeding, it will be presumed, it will be deemed that any notice which was required to be served on him was duly served in accordance with the time. However, such a deeming fiction shall not apply when the assessee has raised an objection. अगर आप assessment के दौरान ऑफिसर को बोल देते हो कि I object to this reassessment or this assessment because notice आपका invalid है, तो उस केस में भले ही officer is forcing you to file the submission, is issuing the notice and you actually file, but because you have raised an objection, that means you still stick to your stand that the proceedings are invalid and therefore any order which is passed pursuant to an invalid proceeding can be declared or held to be a illegal order or contrary to the provisions of law. Now let us, similar to the above question, let us have one more question. The assessment of Mr. Sharma. Just read it and then we discuss in detail. So largely the question is similar with slight change in facts. Students, please answer this. This is kind of a mock test session also. I believe you are having module institute provided material with you, and you can easily go through section 292 double B. You can go through section 143 subsection 2 143(3), and then by reading these 2 or 3 provisions you can answer this question very easily, but it has to come from you. Okay, so one answer is assessing officer contention is valid, which means the assessee is wrong and the order is valid. Okay. Any reason for that? What is the reason that assessing officer's contention is correct? Can you just go through the provision once and then come back and see if your answer changes? Or read the question minutely, word by word, and then try to answer it. These are all practical case studies based on some case laws, based on real life situations, what is happening across in different cases. So very important conceptually. Okay. So your first answer was AO is right. And your second answer is assessee is right as no notice issued. So you have corrected yourself and the second answer is correct. If you read the answer and also section 292 double B, what it says, any notice which is required to be served upon an assessee shall be deemed to have been served, and assessee would be precluded from taking any objection that notice was not served upon him, not served upon him in time, or served upon him in an improper manner. But if you look at the question, it says no notice was issued. That is why, if you remember, whenever I have discussed the word served, I have always differentiated the word served from the issued. Issued means the notice has actually been issued by the officer. It is prepared and issued. Served means it has reached the hands of the assessee or eyes of the assessee. There's a difference between these two. If it is not issued, it can never be served. That means it is not in existence at all. That means 143.2 was never prepared, to put it in a very layman's term. And not served means it is issued. It is prepared by the officer, signed by the officer. Just that it is into air. It is not served to the assessee. That's it. Or it has been misplaced. So that is why 292 double B, it deals with not serving in time or serving in an improper manner. It does not cure a defect of non-issuance itself. अदरवाइज क्या होगा, बिना नोटिस इशू के सब असेसमेंट शुरू कर देंगे और बाद में बोलेंगे हमारा असेसमेंट ऑर्डर वैलिड है क्योंकि तुमने पार्टिसिपेट किया, इसीलिए 292 डबल बी का हम प्रोटेक्शन ले लेते हैं, असेसमेंट इज वैलिड. दिस इज नॉट द इंटेंशन ऑफ लॉ. You have to do your first action, issue the notice, and then service could be another issue, which is a curable defect. So this is what was held by the court, Supreme Court, in case of CIT versus Lakshman Das Khandelwal, 2019, 417 ITR 325. Now, these days, I think the how do I determine as a taxpayer whether notice is issued or not? If somebody is having practical experience of faceless assessments, he can easily make out. Anyways, now let us deal with case scenario. Just go through the facts. Just text me here in the chat box once you are done. So we can turn to the questions. Done? Okay. Now let us read the answer. Let us read the questions now, MCQs. What is the amount of penalty leviable on repayment of loan to Mr. Arun? So first question, which is not mentioned here is, which section will be attracted or which section is violated in this situation? The transaction is simple. There's a repayment of loan to Mr. Arun. The question is, which section is violated by the company, that is Gamma Limited? And then we come to the second question. What is the penalty to be imposed for such a violation? Perfect. Section 269T. Good going. Now give me the answer. What is the amount of penalty that will be imposed? Do you want me to go back to the question? So you see the top of the screen. The company made the following repayments during the year. 18,000 to Mr. Arun on 15th July and cross check. 1,25,000 through account pay check on 10th August. 21,000 on 8th October through RTGS. And 3,000 on 12th December on through cash. So all four types of payment: cross check, account pay check, RTGS, and cash. Yes. So one of the answer is 21,000 penalty, which is option B and section 271E. Okay. Any other answer? So far, we have received one answer. So assuming there are no other answer, let me give the answer. The correct answer is, as rightly mentioned by a student, it is option B, 21,000. And if you see the opening outstanding, that is the loan availed was 3 lakh on 20th April 2024. And then the repayment was done on 15th July, amounting to 18,000 in cross check. Now, cross check is not accepted mode of repayment. And 1,25,000 through account pay check, perfect. 21,000 through RTGS, again perfect, no 269T. 3,000 through cash. So that attracts again the 269T violation. Collectively, it exceeds 20,000. So, and not, sorry, so opening balance is 3 lakh rupees. So any payment that violates 269T provisions, that would be hitting the penalty under section 271 capitally, which is answer is B, which is 21,000. Let's go to question number 2. Assuming that the underreporting of income is on account of misreporting, the penalty leviable on gamma under 270 capital A at the time of assessment under the 143.3 under section 143.3 would be what amount? So you have 4 options, and it's simply assuming it's a misreporting, what would be the penalty amount? I'll just go back to the question. The income as per return was a loss, 10 lakh. Under 143.1, it was again reduced to 5 lakh. And under scrutiny, it got reduced to 1 lakh. And under reassessment, it again converted into an income of 5 lakh. And you can assume that 115 BAA or BAB is not applicable. So let's take it to be a 30% tax rate. The turnover of the company was 405 crores during the previous year, 22-23. Please compute the penalty amount. As such, I don't have to give the option also, but let me give you the options. In exam, you may not have the options as such. You have to compute the penalty. You have all the facts. Okay, so one answer is option C, which is 1,24,800. Okay. So if you are giving the answer C, can you just also provide how did you compute it? What is the underreported amount? And what is the tax rate you applied? And what is the working to arrive at 1,24,800? Just describe in 3 lines quickly. So it is the difference between 5 lakh to 1 lakh, which is 4 lakh rupees. On 4 lakh rupees, we applied 30% plus 4 percentage surcharge. I mean, sorry, education says. So effectively 31.2 percentage. Okay. So the first answer is option C, 1,24,800. Any other answer? Or would you like to revisit your answer? So you have 30 seconds and then I'll provide the correct answer or declare the correct answer. Okay. So one more answer. Option D. Okay. All right. So we have two answers. One is 124,800. Second is 249,600. And the correct answer is option D. That is 249,600 and not option C. The only difference is under option C, you are computing as if it is only an underreporting of income. Whereas if you read the question carefully, it says assuming that the underreporting is on account of misreporting. And as you know, for a case which falls under a misreporting, there the penalty amount would be usually twice the amount of tax liability. So that makes it answer D, 249,600, which is the correct answer. Let's move to question 3. So assessee has availed loan in cash from various vendors. What is going to be the amount of penalty in this case? Should I go back to the question once? Oh, sorry, the facts of the questions. So during the year, it received the following loans in cash from various vendors due to business exigency. So 3 loans have been taken. 3,19,500 and 2,500. And all three have been taken on different dates from different persons. 3,19,500 and 20,500. And you have 4 options. 3,19,500 and 20,500, all taken in cash from 3 different persons during the same financial year. What is the amount of penalty? I think it should be easy to answer by the student because we have recently did study this section. We understood the provisions in detail. Anybody? Gopika, you want to try once?
C.
Okay, so you want to see the facts. So you don't
Sir,
have
option C.
option C. Option C is penalty of 3,40,000 under section 271D. Okay. So one answer is option C, 3,40,000. Why so? Do you want to read the provision once? Section 269 SS. 269 SS. Just have a look at it and then try to answer. See, for any, I would suggest, of course, in exam you may not have it, the access of it, but for any question relating to tax, no matter what or how strong is your understanding of that provision, always and always make it a thumb rule that you have to open it even if the question is simple and you are aware of the provision. So far as you are having an access, open it. The number of times you open it, the number of times you read it, you will be able to memorize it, you will be able to analyze it automatically. Otherwise, you will be just going by an overconfidence. The correct answer in this case is answer A. And I'm surprised that we have given the answers to the difficult questions. This was one of the easiest. Now, if you look at 269 SS, let me open it. That is the first, and I think a lot of us have done the tax audit already. What it says, no person shall take or accept any loan or deposit or specified sum from any other person, except by account pay check, account pay bank draft, or use of electronic clearing system through a bank or through prescribed mode if the amount of such loan, deposit, or specified sum or aggregate amounts of specified loan or deposit. Second, on the date of taking or accepting loan or deposit, any loan or deposit by such person from the depositor. And if you recollect, just 30 minutes back, I had discussed this provision and I highlighted the same depositor is remaining unpaid. So from the same depositor, the amount remains unpaid. And third is the combination of 1 and 2 and the aggregate amount exceed 20,000 or more. Now, if you look at and apply this provision to the facts of the case, the facts are, I have accepted 3 lakh in cash from Arun. So yes, straight away violation. I have received 19,500 from Raj, not from Arun. So therefore, this would be out of the purview of SS because the transaction with a single person doesn't exceed 20,000 and there is no any other transaction. Third, 20,500 from Mr. Sunil. So therefore, again, it is crossing a single event or a single transaction value which is exceeding the prescribed limit. So what I'll take is 3,20,500. First transaction and third transaction. So correct answer will be not C, but it will be option A, 3,20,500. Let's now move to the last question. Question number 4, which is relating to the penalty. Should I share the details and facts of the question again? So these are the particulars. Returned income is a loss 10 lakh. CPC issued the intimation under 143(1)(a) that is reduced the loss to 5 lakh. Assessed is 1 lakh and reassessed is 5 lakh positive income. So the tax rate would be effective 31.2%. Now the question is, at the time of reassessment. Okay, so one of the answer is option A, and that's the correct answer. Option A, 93,600. This is a case of underreporting of income. All right, so well done. Let us now move to the remaining topics of this chapter. Those which are important ones we will touch upon. 281 and 281B we already did. Notice deemed to be valid in certain circumstances. 292BB we have done. What we have not discussed is section 285BA and 285BB. That is practically very important, so we'll touch upon it right now. And then we will discuss some more case studies relating to TDS chapter. Two 285 bar. 285BA imposes an obligation on specified persons to furnish the SFT, Statement of Financial Transaction or Reportable Account. The section also provides for furnishing of statement by a prescribed reporting financial institution for some financial transaction or reportable account to the income tax department. So this section is mainly putting an obligation on number one, the specified persons, and number two, the specified financial institutions. Who are the specified persons? An assessee. Then we'll see some additional conditions are there. Prescribed person in the case of government. And likewise, you can see the list goes on. All of them are the specified persons or they are the specified financial institutions. Second, point 3. Specified financial transactions. What is it? Now, it covers a normal transaction of purchase sale, a service transaction, works contract, investment or expenditure, or taking or accepting any loan. So practically, all kinds of transactions are covered. As per Rule 114E, the statement of financial transaction shall be furnished in form number 61 capital A, and it will be verified in the prescribed manner therein. What is the due date? Before 31st of May, the specified person has to file the SFT report, Statement of Financial Transactions. If there is any defect, in that case, he will have to rectify it within a period of 30 days. And if the defect is not rectified, in that case, it will be deemed that he has not furnished, or it will be treated as an inaccurate information furnished in the statement. So that is all about discrepancy and rectification and timeline. So we are not discussing all of it. What is important is to understand which type of transactions are required to be reported, by when and by whom. So the first one is reporting to be done by a bank, a banking company, cooperative bank to which the Banking Regulation Act of 1949 applies, including any bank or banking institution referred to in section 51 of that act. What kind of transaction? So the first transaction. If any person has made payment in cash for purchase of bank draft, pay order, banker's check of an amount aggregating to 10 lakh or more in a financial year. It's important to understand the logic. Bank draft, pay orders. Now what happens if I go to the bank, I make a payment of 1 lakh in cash, and I ask them to draw a pay order or a bank draft in favor of Mr. X. Now, this whole process usually avoids, kind of a KYC norm. That was the situation, and a lot of it happened mostly in the cooperative banks, where you go to the bank, deposit the cash, you get a pay order or a demand draft, and you give the demand draft to anybody. Anyone can go to the bank and cash it. So how it happens? It simply is that you can easily transfer the money without following the banking procedure. And therefore, the banks these days, they are very reluctant to do it without proper KYC, but if at all it is happening, then they are supposed to report it. Second, payment made in cash aggregated 10 lakh or more during the financial year for purchase of prepaid instrument issued by the RBI. Right. Third, cash deposit or cash withdrawal aggregating to 50 lakh or more in a financial year in or from one or more current account of a person. So if I have a current account in a bank, whether one or multiple, and if I deposit 50 lakh rupees or more, or if I withdraw 50 lakh rupees or more, in either of these situations, the bank is supposed to report it to the income tax department. Second, and one of the most, cash deposits in aggregate to 10 lakh or more in a financial year in one or more accounts other than a current account or a time deposit account of a person. So if I have a savings account or any other account which is other than current account or time deposit account, that is fixed deposit, and if I deposit the money which is 10 lakh or more and into cash, then the bank is supposed to inform this to the income tax department in the prescribed form by 31st of May. And likewise, the post office is also obligated to disclose this. Now, generally, we don't have a current account with the post office. That is why they are talking here mainly about the savings account. So that's why the post office is covered in point 1 and not covered in in point 2 and not covered in the first one. One or more term deposit or a time deposit of a person which exceeds 10 lakh or more in a financial year. So here the cash element is not there. If I'm making a cash term deposit of 10 lakh or more in a year, then the bank is supposed to report it. Payments made by any person of an amount aggregating to 1 lakh or more in cash or 10 lakh or more by way of any other mode against bills which are raised in respect of one or more credit cards issued to that person in a financial year, right? So a banking company or a cooperative bank to which the banking regulation apply, they are supposed to report it. Fifth one, receipt from any person of an amount of 10 lakh or more in a financial year for acquiring bonds, debentures. So any company, private, listed, unlisted, or an institution which is issuing bonds and debentures, if they are receiving 10 lakh or more in a year for acquiring bonds and debentures, they are supposed to report it. A company issuing shares. So if any company is issuing a shares and receiving consideration from a person in aggregate to 10 lakh or more in a financial year for acquiring those shares, they have to kind of report it. Buyback of shares from any person other than the shares bought in the open market for an amount or value aggregating to 10 lakh or more in a financial year. Now, a listed company on a recognized stock exchange is covered here. And likewise, there is reporting requirement on mutual funds, reporting requirement on the authorized bank, so on and so forth. So the transaction relating to the property, serial number 10 is also important. If you purchase a property or sell a property, the value of which is 30 lakhs or more, or valued by the stamp duty authority or stamp valuation authority is 30 lakhs or more, then the concerned registrar will report it to the department. So if you purchase a property, that property, you will get an executed document done at the registrar, then obligation is on registrar to report it. That's why you will see that these days when you open your AIS account, 26 years or TIS, you find 26 years is mostly about the TDS related transactions. But in AIS, you will find many other transactions relating to subscription of shares, purchase and sale of shares, relating to the transaction of purchase of immovable property and all of it. How do I apply the threshold? Just read it. Easy to understand. You might have come across a case where, let's say, if a husband and wife are holding, or they are the common beneficiaries, they have a common or a single bank account. If they are purchasing a property, or let's say, take a simple example, they have kind of created a term deposit, fixed deposit of 50 lakh, let's. Now, the primary account holder is, let's say, husband, and secondary account holder is wife. In whose name the FD should be reported and of what amount? Have you seen any such situation? Husband and wife having a common bank account. Primary holder is husband, secondary holder joint operator is wife. दोनों ने अपना पान नंबर दिया है बैंक वाले को. What is the question is, बैंक वाला किसके नाम पे ट्रांजैक्शन दिखाएगा टर्म डिपॉजिट? हस्बैंड के नाम पे, वाइफ के नाम पे, के दोनों के नाम पे? You have to answer this on the basis of the paras which we have highlighted. Manner of application of threshold limit. A spot case study. All right. So you can let me know later once you arrive at an answer. So this is largely about section 285BA. Now, what is the penalty if there is a failure to report or there is a non-compliance? So there's a 500 per day for continuing default, and there's a 1000 per day for again a continuing default. So let's say I'm supposed to report the transaction on or before 31st May. If I don't do that, then the officer may direct a penalty of 500 for every day during the default continues. So that's quite huge. So just have a quick look at the example and then we move forward. So in this case, so we have divided it into two parts. For the period of 1st June to 31st October, the delay would be of 153 days. That is up to the date of issue of notice, and the penalty would be 76,500. And therefore, due to continuing default, from 1st November to 15th November, there would be penalty of 1,000 per day, and that would be 15. Right? So that's all for this chapter. I think rest is we are not discussing because it's quite easy. And let us now touch upon another chapter and its case studies. And I think what is important is TDS and TCS related case study. I think first question is quite easy. So the first one is fairly easy. 194N, that will be attracted in this case. The total deposits will be considered, which is 68 lakhs and 58 lakhs, totaling to 1 crore and 26 lakh. And any amount in excess of 1 crore will attract the TDS. And the bank is supposed to do it at 2%. Second question is interest of 98,000 on capital gain bonds issued by Power Finance Corporation Limited, which is an Indian company, to Mr. Ajay, aged 52, non-senior citizen, but a non-resident individual. So he's a non-resident individual earning an interest income from a company which is resident in India on the bonds which are issued by the Indian company. The question is, what will be the TDS implications? Or under which section the provisions would be attracted? Any answers? I think we really don't need to discuss all the TDS provisions. You have been doing it since your intermediate exams, so not much. No need to go through each provision, but yeah, I expect answers. Right. So in this case, we have section 195, which basically deals with the payment of interest and other sums to the non-resident, except the interest referred to in 194 LB, LC, and LD, which are specifics. That doesn't cover interest on bonds issued by an Indian company. So in this case, section 195 will be attracted and not 194 LB, LC, and LD. A very straightforward question. Second, and again, one of the very interesting and important from a tax planning point of view as well. So an Indian company pays the salary, including allowance and monetary perquisites, of 7,30,000 to its GM, who is not a senior citizen. The company also provides non-monetary perquisites to him, valued at 1,20,000. Employee has not given any declaration regarding opting out of 115 BSE. That means he has followed 115 BSE. The question is, you are supposed to determine the tax liability, TDS, tax liability, and then the TDS to be deducted in the hands of an Indian company. And what would be the tax implications so far as the tax on non-monetary perquisites is concerned, assuming it is borne by the company. So that line is not there in this question, but that is also an additional question to be added. So if you look at the computation, the gross salary 7,30,000, we add non-monetary perquisites 1,20,000. So we arrive at a total gross 8,50,000. Standard deduction, as you know, also is available under the 115 BSE option. So net income is 7,75,000, on which the tax liability would be 28,600, right? Now, the average tax rate would be 3.69% in this case. And so therefore, the tax on non-monetary perquisite would amount to 4,428. Now, the question was, what would be the implications, assuming this tax on non-monetary perquisite is borne by the company and not by the employee? That means they are not recovering any taxes from the employee. Company is going to pay from its own pocket. What would be the implications? All right, let's look at the answer. Now, as we all know, if a tax on non-monetary perquisite, so there is a difference. One is a perquisite, which is non-monetary in nature. So any perquisite, whether monetary or non-monetary in nature, that is always taxable in the hands of employee. But if the tax on the non-monetary perk is borne by the that means I'm not asking employee to pay the tax on it. I'm paying the tax on it. In that situation, I am discharging an obligation of an employee, and it is also a benefit for an employee. But from a tax point of view, under section 1010 CC, it is completely exempt in the hands of employee. For an employer, there is a disallowance under section 40, clause A, subclause 5. So this is the answer. Let's read question 3. During the year 24-25, previous year, Amit purchased a scrap of 65 lakhs from Mr. Bharat for the purpose of his manufacturing. Mr. Amit also furnished a declaration to Bharat that the scrap will be used for manufacturing process carried on and it will not be used for trading purpose. Amit made the payment of 49 lakhs to Bharat. Now assume the turnover of both Amit and Bharat exceeds 10 crore during the financial year 23-24. Can determine the TDS obligations or TCS obligation, whatever it is. Now we all know section 206C1A. 3 sections will come into play here. One is 206C1A. One would be 194Q and another would be 206C1H. Now the primary special versus general principle we will apply here. 206C1 is specific to scrap, but under 206C, there won't be any collection of TCS in this case. Why? Because as you know, the declaration has been furnished and the declaration specifically provides that it is not used for trading purpose, it will be used for manufacturing. So no TCS on first place. Now, having said that, while TCS is not applicable, TDS provision will come into play. Now there will be an interplay between 194Q and 206C1H. Now you all know that if the purchaser or the buyer is making TDS under 194Q, which is the primary obligation, then seller is not supposed to do. Now in this case, the buyer and seller both have the turnover in the preceding year exceeding 10 crore. So therefore, buyer is supposed to do the TDS. And secondly, the transaction value also exceeds 50 lakhs. So therefore, he will do the TDS under 194Q. Once the TDS under 194Q is done, TCS under 206C1H is not required to be collected by the seller. Let's discuss another case, a very interesting one I'm touching upon. The straightforward answers, I think I'm not dealing with them now. So this is the last one. Mr. Mukesh, an individual carrying on retail business with turnover of 3.2 crore in the previous year, 23-24. So there's a retail business, turnover is 3.2 crore. He made the contract payment for repair of residential house of 3 lakh and 75,000 towards commission on 1st October 2025. So repairing of residential house and commission of 75,000 to Mr. Varun for business purpose. Examine the TDS provisions would be attracted if he has specified the rate and amount. Question 2. Mr. Rajesh, who gets his accounts audited under 44AB, he filed his original return of income under 139 for FY 22-23 on 28th December, and he declared an income of 12 lakh. And for the next year, FY 23-24, he filed the return on 31st October and declared a loss of 5 lakh. Now he wants to file an updated return under 139.8A on 30th November, declaring total income of 7 lakh. Can you do so? Now this question relates to what we discussed yesterday about the concept of updated return. Let us see the answers. In the first question, the TDS under 194C is not attracted. Why? Because 3 lakh is for repair of residential houses for personal purpose. Whereas TDS under 194M is again also not attracted. Why? Because the aggregate contract payment to the payee doesn't exceed 50 lakh rupees. However, for the 75,000 commission, which is for the business purpose, the TDS, as you know, under 194H is 5%, and that TDS payment will be attracted. Why? Because 75,000 exceeds 15,000 rupees. And having said that, the turnover of Mukesh for business exceeds 1 crore, and therefore he is supposed to do the TDS of 3750 on the entire amount of 75,000. Let's come to the answer for the second question. Whether he can file the updated return? Answer is yes, he can do so. Now, if a person has a loss and he has furnished a return of loss under 139.3 on or before the due date of filing under 139.1, he'll be allowed to furnish an updated return if the updated return is a return of income. That means I'm not decreasing my tax liability, I'm not increasing my loss, I'm not claiming excess refund. These are the three things that we were supposed to remember. Now, in this case, none of this is happening. Therefore, since the original return was filed on due date, and he can file an updated return within 2 years from end of AWAT 2024, that is by 31st March 2026. Right. So I think with this, we conclude the case studies and the session for today. If there are any specific questions relating to any of these chapters that we discussed or any other chapter, please feel free to put in the chat box or onto the BOS portal so that we can address it. Or we can also discuss in the subsequent sessions as well. All right. So if there are no questions, then Manishji, we can conclude the session. Okay. Thank you so much. Thank you so much, participants, for your patience. Bye-bye.
Yes, sir. No, no. Okay.